For decades, European financial institutions relied on a predictable cycle of IT general control audits. These reviews focused on point-in-time policy compliance. Under the Digital Operational Resilience Act, that siloed model is legally insufficient. Dora mandates that firms move beyond policy documentation. It requires every bank, insurer, and investment firm to provide evidence that they can maintain and restore critical services during a severe ICT disruption. The regulatory focus has shifted from intent to verifiable outcomes. While traditional audits confirmed that a cybersecurity policy existed, a Dora audit requires proof that the underlying systems remain operational when those policies are put under stress. This creates a gap in the current assurance model. An institution can pass a standard cybersecurity review and maintain high capital ratios, yet fail a Dora assessment because their recovery procedures have never been tested against actual service downtime. Since January 17, 2025, these requirements have been a binding legal reality. European regulators now treat technology resilience as a core component of financial stability. For an auditor, verifying this resilience requires a new approach. You cannot rely on a pre-existing organizational chart. You must construct a risk-based audit universe from the ground up. Building this universe begins with a dependency graph, centered on a single regulated business function. Without a map that connects technical assets to these business dependencies, a compliance report holds no regulatory value. We start by identifying a critical function, such as payment processing. This function relies on a specific chain of internal infrastructure to operate: authentication modules, core ledgers, and the internal cloud environments that host them. Dora establishes the ICT asset inventory as a primary control. This inventory provides the technical map needed to link every server and database to its specific regulated business purpose. If a single authentication component is missing from the inventory, the entity cannot accurately assess the impact of a system outage. The map breaks, and the resilience claim becomes unverifiable. Auditors must therefore trace the full dependency chain, identifying exactly what is required for a service to start and what is affected if it stops. The audit question is direct. If this specific API goes offline, exactly which regulatory reporting feeds will fail to submit? This mapping is often undermined by shadow ICT, the unauthorized cloud tools or software acquired by business units without central oversight. These unmapped tools often process sensitive data or support daily workflows, yet they sit entirely outside the entity's disaster recovery and security monitoring programs. Dora makes the financial entity legally accountable for any disruption caused by these tools if they support a critical function. If the underlying map of these dependencies is incomplete, the audit cannot provide a reliable opinion on operational resilience. Resilience under Dora requires the auditor to look outside the entity's own walls. The audit perimeter now extends to every technology provider in the delivery chain. To manage this, firms must maintain a register of information, a detailed inventory of every external ICT dependency. Our dependency graph now expands to include external vendors. SaaS platforms, cloud hosting, and managed security providers are now integrated nodes in the internal architecture. Auditors must reconcile this register against actual accounts payable data to identify any hidden providers that have not been subjected to Dora-level due diligence. This reconciliation often reveals that a primary vendor relies on several other subcontractors to deliver their service. Dora requires visibility into this entire chain. This visibility is the only way to detect the buildup of concentration risk. If you audit each vendor contract in a silo, you might conclude that each individual service is well managed, while missing a massive shared vulnerability. As we pan back, we see the reality. 3 unrelated software providers may all rely on the same underlying infrastructure provider. If that single point of failure suffers an outage, the failure travels up the graph, simultaneously disabling multiple critical functions across the entire financial entity. Because of this risk, Dora requires entities to document and maintain credible exit strategies for these concentrated providers. A contract clause is not an exit strategy. The auditor must see evidence of data portability, the technical ability to move operations to a different provider without losing data integrity. National and European supervisors are now using this same mapping logic to identify systemic risks that could threaten the entire financial sector. Outsourcing a service does not outsource the regulatory duty to keep that service running. With the map established, the audit moves to testing. Dora demands evidence of operating effectiveness, not just a description of a control's design. Consider how this changes the audit of data backups. In a Dora audit, a backup successful log is insufficient. A successful backup is only the first half of the resilience requirement. The entity must provide evidence of restoration. They must prove they can restore the system and resume service within the specific timeframes required by the business. For the most significant firms, this testing reaches its peak with threat-led penetration testing. These tests use real-world intelligence to simulate a live attack. They challenge the entire dependency graph, testing whether incident teams and security tools and third-party vendors can actually contain a threat in real time. Under this regime, a control only truly exists if there is empirical evidence that it works during a crisis. These technical and operational layers connect directly to the board. Dora makes ICT risk the personal responsibility of the might of the body. We can visualize this as a governance layer presiding over the entire dependency graph. Auditors must distinguish between formal governance, the mere existence of committees, and effective governance, where the board actively directs the resilient strategy. If a recovery test fails or a vendor remains uncooperative, Dora requires those risks to escalate. The board must see the risk and authorize the corrective investment. Delegating these issues to the IT department does not protect senior management from regulatory liability when a critical service fails. The auditor's role here is to verify that the board is actually tracking these issues to closure and challenging any delays in remediation. Governance without documented corrective action is simply a record of operational negligence. This is the Dora audit universe. It links legal duties to operational facts. Auditors use this to create a heat map, identifying where resilience is most vulnerable. This risk-based plan focuses resources on the red zones, critical functions, concentrated vendors, and failed tests. Dora establishes a strict discipline of proof. Assumptions about technology are no longer sufficient. Every claim of resilience must be backed by data. The goal is not to stop our use of complex technology, but to finally subject that technology to verifiable, board-level discipline.